In this episode of the FXTM educational series, we're going to be taking a look at the RSI oscillator, or the Relative Strength Index oscillator. This was created by Wells Wilder, who's a real legend in the technical analysis world. Now, the RSI oscillator, like many oscillators, is basically a momentum indicator, and it analyzes price over time. Now, here I've drawn an example of a price chart with an idealized version of the RSI. It is range bound, which means that it cannot go beyond 100 and it cannot go lower than 0. Now, one of the interesting things about the RSI is that we look at it as when it gets really high, it indicates that the price may be overbought or potentially overextended in certain circumstances. When it's really low, then we would suggest that it may be oversold. The price may be oversold, and that's important, but only in specific circumstances. We're going to cover a few of those in this video. Now, when we define overbought or oversold, we're really talking about a range, so not all the way to 100 or all the way down to 0. So we look at anything that is overbought would be above 70, and we'll call that 70%, or below 30, or 30% right there. So you might imagine that there's a couple of lines here that are going like this, that when the oscillator is above that 70 region, and again, similar situation down here, anytime the oscillator is below 30, it's telling us that the price is oversold. Now, the oscillator does this, so it analyzes price over time by evaluating the average gain versus the average loss over a specific look-back period, which the default is 14 periods, or if you're looking at a daily chart, it'd be 14 days. So let's think about it like this. We've got the average gain divided by the average loss over that look-back period. Now, that calculation is then further manipulated so that we can put it on a ratio graph here where it can't go above 100 or below 0. But that's basically what we're doing. So the average gain versus the average loss. So obviously, if the price is rising, then we would assume that the oscillator should also be rising because those average gains are going to be larger overall in that look-back period. And we would also assume that if the price is falling, meaning that those average losses are starting to outpace those average gains, then the price and the oscillator should both be declining, which, as you can see here, that's generally what we're going to observe. Now, what we're looking for here is we're looking to identify times when the oscillator is giving us a signal that either bulls or bears may be a little overextended, not just that they're in overbought or oversold territory, but that they are likely to, or potentially likely to, reverse course, or that the trend may start to consolidate, something of that nature. So one of these signals that we'll be looking for are called a failure or a failure swing. Now, a bullish failure swing looks like this, where we get a period where the price is dropping, of course, and the oscillator gets into oversold territory. It rallies and then forms a top, which you can see there. It declines, but the next bottom does not form a lower bottom, is not lower than the original bottom here. And then subsequently, the oscillator goes above that top in between those two bottoms. So that is a bullish failure swing, and we call it that because the second bottom did not extend below the first one. So it failed to extend below the first one. And of course, we would look at that as a positive sign for the trend. Now, a bearish failure is just the reverse, of course. Here we have the prices has likely been rising or maybe consolidating at the top, and we get the oscillator in overbought territory, followed by another rally, which in the oscillator, so we have another top here in the oscillator, it's in overbought territory, but it does not get back to that prior top, and then subsequently declines through the bottom in between those two tops. So that failure, that bearish failure, is telling us that the bulls are likely overextended. We may see a change in the trend. If this were in favor of a long-term bearish trend in the price, then traders may even consider that actionable as a short signal, or certainly, if nothing else, a exit signal for longs. In fact, let's take a look at a couple of examples of bullish and bearish failures on an actual price chart. Now, before we look at these examples, let's add the 50% line to the indicator. Now, in order to do that, put your mouse over the indicator itself, right-click, and then select the indicator's parameters. Now from here, you can see that you can add a level, which we're going to do. We're going to set it at 50%. From there, all you have to do is click OK, and your 50% level has been added. So here you can see a bearish failure swing where the oscillator did get above 70, so it did get into overbought territory. It rallied again and began to rise, formed another top that was not above the first top, and then fell below the bottom in between those two tops. So that completes the bearish failure swing. This bullish failure swing is just the reverse of what we were looking at, where the oscillator got down into oversold territory. It began to rise, formed a top, and then came back down, formed another bottom that was in fact higher than the bottom that came before it. So it failed to form a lower bottom, and then subsequently it began to rise again and took out the top in between those two bottoms. So this completes the bullish failure swing. Now the RSI indicator can also do a really good job of helping us to identify bullish and bearish divergences. Let's look at a couple of examples of this. Now, a bullish divergence occurs when we have lower bottoms on the price, which we might normally assume is telling us something about building bearish momentum, and those same bottoms are accompanied by higher bottoms on the oscillator. So we have rising bottoms on the oscillator, falling bottoms on the price. This is telling us something about bullish momentum beginning to build. Now, if a bullish divergence were to occur in a very strong downtrend, or a bearish divergence were to occur in a very strong uptrend, we should look at them fairly skeptically. This is going to be a much more valuable signal if we were to see a bullish divergence, for example, in a long-term primary uptrend, and that occurred just as the price had been pulling back against that trend, where an investor might see a bullish divergence as something that's more actionable for a new long position. Now, a bearish divergence is very similar, except everything is flipped upside down. We have rising highs on the price, which normally we would suggest indicates building bullish momentum, so rising tops on the price with falling tops on the oscillator. So this divergence between these two, falling tops on the oscillator, rising tops on the price, is telling us that bullish momentum is actually beginning to wane. And if this were to occur in a primary downtrend where the price has just been rising recently, a retracement against that trend, investors may look at that as actionable. Now let's look at a couple of examples of these on the charts. As you can see here, we have a good example of a bullish divergence where we have rising bottoms on the oscillator with falling bottoms on the price, indicating that bullish momentum is actually beginning to build. This example of a bearish divergence is just the opposite of what we saw with the bullish one, where we have falling tops on the oscillator accompanied by rising tops on the price. So this difference between those tops and bottoms is telling us something about bearish momentum beginning to build. The RSI oscillator tells us a lot about what's going on in the trend and how strong the momentum is within the trend and how likely it is to reverse or consolidate.